Some corporate bonds can be taken away from you. The company hands back your money years early, whether you wanted that or not, and it always happens at the worst possible moment for you. That feature is called a call, and the exam tests whether you understand who it serves. And there's a bond in this family that pays you in a completely different currency if you want it to, which sits at the boundary between everything we covered last week and everything we covered before that. Corporate debt is where the bond family gets its features. Treasuries were plain. From here, every product is a bond with something bolted on.
FINRA here, and the base is familiar. The SEC says a bond is a debt obligation, like an IOU, and investors who buy corporate bonds are lending money to the company issuing the bond.
Nova here. Lending to a company rather than to the government, which is where the first real difference comes in.
Because a company can fail. The SEC defines credit or default risk as the risk that a company will fail to timely make interest or principal payments and thus default on its bonds.
Which the Treasury essentially doesn't have, and every corporate issuer does to some degree.
And that's what a rating is for. Credit ratings try to estimate the relative credit risk of a bond based on the company's ability to pay.
Note the word try. That's the SEC's own word, and it's doing real work, which we will come back to.
And it's worth saying where a corporate bondholder sits relative to everything else, because it connects straight back to the queue. A bondholder is still a lender, so they rank ahead of both preferred and common shareholders if the company fails. The credit risk we're describing is the risk that even that senior position isn't enough.
Then the feature that changes the whole shape of the investment. A callable bond gives the company the right to buy back the bond before the maturity date. The SEC says that's known as calling the bond.
And a company will only choose to do that when it suits the company. And a call isn't a rare exotic feature you'll meet once. A great many corporate issues carry one, which is why it belongs in the fundamentals rather than in a footnote. Assume a corporate bond might be callable until the terms tell you otherwise.
Which means when rates have fallen, if it can borrow more cheaply now, it repays your expensive bond and reissues at the lower rate.
Erica, so why would anybody buy one? That sounds like a coin that only lands on the company's side.
Quick honest ask while we are here. If this has been worth your time so far, hit like, then subscribe and ring the bell. I know everyone asks, but this one is free, and it is how a small channel like this actually grows. FINRA asked why anybody accepts a feature that only ever helps the issuer, and it's the right question because the answer is the same shape as everything else in this section.
It needs someone who works on how these features are actually priced.
Professor Adeyemi studies how optional features in debt securities are valued, and picked out FINRA's question before we started.
FINRA is right that the option belongs entirely to the issuer. Where he's wrong is in thinking it was free. The issuer is buying that right from you, and the price it pays is a higher coupon than an identical bond without the feature.
So the extra yield is the payment for the risk.
It's compensation for a specific risk, which has a name worth knowing. Call risk isn't the risk of losing money, you get your principal back. It's the risk of being handed your money at precisely the moment there's nothing good to do with it.
Because rates have fallen, so anything you buy next pays less.
That's reinvestment risk, and it's the actual injury. You held a bond paying 7%, it gets called, and the best replacement pays 4%. Nothing was stolen, and your income has still fallen by nearly half.
And is there any protection for the holder?
Commonly, yes. Many callable bonds carry a period after issue during which the issuer may not call at all, which is called call protection. The exam likes it because it's a concrete term attached to a simple idea.
So the honest summary is that it's a trade rather than a trap.
A trade, priced and disclosed before you buy, which is the pattern of this entire section. Every feature that helps one side is paid for by the other, and the exam is usually asking you to identify which side is being compensated.
Is there a case where a callable bond is genuinely the wrong choice?
There's a second way to see why the compensation has to exist, which some people find clearer. Think about what the issuer has actually bought. They have bought the ability to escape a bad deal while you remain stuck in yours. Nobody hands that asymmetry away for nothing, and the coupon is where it gets settled.
For an investor who needs income for a fixed period, yes, and I'd say so plainly. If you're funding 20 years of something, a bond that can vanish in 5 is a poor match, however good the coupon looks. The extra yield doesn't help if the whole point was certainty.
Professor Adeyemi, thank you. Call risk being about reinvestment rather than loss is the distinction I'd want carried into the room.
FINRA assumed a one-sided feature must be a trick, which is the right instinct even when the answer turns out to be a price.
There's one line running through the whole corporate bond market, and which side of it a bond sits on changes who is allowed to buy it.
And the line has a precise location, which is the sort of thing the exam asks for directly.
Investment-grade bonds are those the SEC describes as believed to have a lower risk of default and receiving higher ratings by the credit rating agencies.
And the boundary sits at BA for Moody's, and BBB for Standard & Poor's and Fitch. At or above that line is investment grade.
Below it, the language changes to high yield, or in plainer speech, junk.
And the SEC's definition of the category is admirably blunt about the causation. A high-yield corporate bond offers a higher rate of interest because of its higher risk of default.
Because of not alongside, not coincidentally. The yield exists to compensate for the risk.
And the mechanism is spelled out too. Companies with greater estimated default risk may be unable to obtain an investment-grade rating, so they issue bonds with higher interest rates in order to entice investors and compensate them for that higher risk. And the practical consequence of that line is bigger than a label, which is why the exam cares. Many institutions are restricted to investment-grade holdings by their own rules, so a downgrade below the line can force selling by people who would otherwise have held. The rating isn't just information, it's a switch.
So a high yield isn't a bargain somebody overlooked. It's a price tag on a known problem.
Which is the exam's whole framing of risk and return, made concrete in one product.
And now back to the word I flagged earlier. Ratings try to estimate. They're an opinion about the future formed by an agency, not a measurement of anything.
So a rating can be wrong.
And can change. A downgrade doesn't alter a single term of the bond, and it will still move the price because the market reprices the risk it thought it understood.
The last feature is the one that crosses the boundary we drew 2 episodes ago, between lending and owning.
And it's the one I found genuinely strange the first time, because it seems to let a bond stop being a bond.
Professor Adeyemi is back with us for this.
A convertible bond carries the option to exchange it for shares of common stock in the same company at a price fixed when the bond was issued. And notice immediately who holds that option, because it's the reverse of a call.
The investor.
You choose. Nobody can make you convert. And by the pattern we established in the last scene, if the valuable option belongs to you, you must be paying for it somewhere.
A lower coupon.
Lower than an identical bond from the same issuer without the feature. That single deduction answers a great many exam items without any knowledge of the specific product because it follows from who holds the option.
So does a convertible bond let a bond stop being a bond? Because that's what it sounds like, and it seemed like a category error the first time I read it.
And what does the investor actually get for that reduced income?
A position that behaves like debt when things go badly and like equity when they go well. If the shares do nothing, you hold a bond and you're repaid. If the shares rise past the conversion price, you can become an owner at yesterday's price.
And there's a number attached to that decision worth knowing by name. The conversion price is what the shares are valued at for the swap, and it's set at issue. Until the market price climbs above it, converting simply makes you worse off, which is why the option can sit unused for years and still be worth paying for. So it's the Q from episode 20 and the upside from it in one instrument.
Which is precisely why issuers use them. A company that can't borrow cheaply on its own credit can borrow more cheaply by attaching a claim on its future growth.
Is there a catch we're underselling?
There's one, and it's fair to name. Converting dilutes the existing shareholders exactly as we discussed with warrants. And a convertible often comes with a call feature attached, which lets the issuer force the decision on its own timetable rather than yours. Read which options are present and who's there.
Professor Adeyemi, thank you. Who holds the option and therefore who pays is the single most portable idea in this episode. So the routine for corporate bonds, which is shorter than the episode suggests.
One question does most of it. Who holds the option? If the issuer holds it, the bond pays you more to accept that. If you hold it, you accept less.
Callable is theirs, so a higher coupon. Convertible is yours, so a lower one. You never need to memorize which way round the yields go.
Then, the rating line. BA or BBB and above is investment grade. Below is high yield, and the yield is higher because the risk is higher.
And notice how much of this section is now the same move repeated. Preferred traded a vote for priority. A callable bond trades certainty for yield. A convertible trades yield for upside. Every product is somebody giving up one thing to get another, and the exam mostly asks you to name which. And one more reason this option question is worth drilling rather than reading. It transfers straight into the next several products. A municipal bond can be callable. A preferred share can be callable. The same sentence keeps paying out long after this episode. And the name of the injury in a call, it's reinvestment risk, not loss. Your money comes back at the worst moment to redeploy it.
There's something worth pushing on in how confidently we've used ratings, though.
Push, because I'd rather a viewer heard it from us.
We've treated the BA line as though it means something exact. It's an opinion, issued by an agency that's paid by the issuer, and the historical record of those opinions isn't spotless. Treating a rating as a fact about safety is how people have been hurt before.
And the counter is that it's still the best available shared standard, and the alternative is every investor doing their own credit analysis, which isn't realistic.
Both true. For the exam, learn the line and what it means. Beyond the exam, hold it as an informed opinion rather than a measurement, which is exactly how the SEC words it when they say ratings try to estimate.
And one practical note for the drills. Questions in this area often give you two bonds from the same issuer with different coupons and ask why they differ. The answer is almost never credit quality because the issuer is identical. It's a feature, and the feature belongs to one side or the other.
Next time we do municipal securities. General obligation against revenue bonds, and the tax treatment that mirrors the Treasury rule from episode 22. If one thing survives today, make it the option question. Every feature on a corporate bond belongs to somebody, and whoever holds it has paid for it in the coupon.
Theirs, you get more. Yours, you get less.
If you're working toward this exam, subscribing keeps the course arriving in order, and the free practice sets on the site now cover the corporate bond items. So before you go, tell me, did you know a company could call your bond back early? Go and drill the option question. This is Professor Erica, and I will see you in episode 24.